Welcome everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back everyone. I want you guys to know Wall Street has your back. They're always looking out for what's best for you, the retail investor, right? They're always warning about what's going to happen in the future. They're most concerned with what's best for you, not their own portfolio, right? From Markets Insider today. Prepare for the S&P 500 to plunge 23% by mid-2024 and the U.S. economy to sink into recession, J.P. Morgan's top charts guru says. Jason Hunter, the bank's head of technical strategy, views a U.S. recession as very likely. Hunter sees cash and treasury bonds as safer bets than stocks today. The stock market is mistakenly pricing in a soft landing for the U.S. economy, where the Fed Reserve succeeds in crushing inflation without causing a recession, Jason Hunter told CNBC's Squawk Box on Monday. But investors will soon realize the outlook is darker than they thought, sparking a sell-off in stocks, the bank's head of technical strategy said. So guys, I'm not saying that we can't get a correction or a recession. What I'm saying is that's exactly what JP Morgan wants. So let me tell you what I'm hearing from the prime bank guys. Number one, you should sell your stocks, because there's going to be a correction. We really need one, and now. No soft landing for you. This current rally is full of caca. Number two, there's going to be a recession, which actually pleases me because theaters do really well during recessions. But number three, we think you should buy bonds because we own tons of them. We have tons of unrealized losses, and we need you to come in and buy them, please. Okay. Listen to this. JP Morgan Chase had unrealized losses of $40 billion in its hold-to-maturity portfolio in the third quarter. Citigroup did not disclose paper losses on its portfolio for the third quarter. Interesting, huh? But they stood at $24 billion at the end of the second quarter. Bank of America's unrealized losses on securities rose to $131.6 billion. Okay, so Citi's not going to tell us how much unrealized losses they have. I would like to point out that Bank of America is a short seller of AMC. Citigroup is a short seller of AMC and our chief investment banker. And JP Morgan Chase, through Highbridge Capital, is a short seller of AMC. Just thought I'd point that out. Did you guys know that the top Wall Street CEOs will testify before Congress on Wednesday? The CEOs of America's largest banks will line up before lawmakers this week in a highly anticipated appearance to try and convince Washington and the world that the banking sector is back on steady ground following the regional banking crisis earlier this year. The hearing before the Senate's Banking Committee is part of Congress's annual oversight of the financial sector and will feature top bosses from Jamie Dimon of JP Morgan Chase and David Solomon of Goldman Sachs, short seller of AMC and epic spoofer of our stock, to Brian Moynihan of Bank of America. Much of the focus during Wednesday's hearing is set to be on the higher capital requirements proposed this summer by the Fed Reserve, called Basel III Endgame measures, which the assembled CEOs have been lobbying furiously against for months. They don't want any part of higher margin requirements for them. You see, guys, I think the big boys have had enough of this rally. It's gone on far too long for their short clients, and they would like you to please get out of equities and buy lots of bonds. Do you know why? Because the bonds they bought are in the toilet, and they need them to rally, especially if the government raises their capital requirements. Here's a headline from Axios. banks' unrealized losses grew in the third quarter. You could see by the red arrow that that's an understatement. From the article, the FDIC on Wednesday released its third quarter update on the state of the nation's banks, showing growing theoretical losses on bank stockpiles of bonds. Why it matters? Such potential losses were at the heart of the collapse of Silicon Valley Bank, which sparked a weeks-long quasi-financial panic earlier this year. The big picture? The banking system is healthy, with high and stable profits and solid scores on the performance of most kinds of outstanding loans. But, the surge in interest rates, which pushes down the value of fixed income securities or bonds, continue to inflict largely theoretical losses through quarter three. FDIC-insured banks reported unrealized losses, except for Citi, essentially the difference between the price they paid for bonds in their investment portfolio and the current market price for those securities, of $684 billion in the third quarter. Be smart. The banks don't have to actually realize the losses on their balance sheets unless they sell the bonds. That's basically what Silicon Valley Bank was forced to do when it needed to raise cash this past spring, leading to its collapse. So you see, guys, the big guys aren't really that concerned about your portfolio. That's why they're telling you the market's going to crash. Please get out of stocks. There's going to be a recession. You should buy lots and lots of bonds. Why? Because we own them and we're taking a serious beating in them. $684 billion, and that's just the third quarter. Okay, enough about unrealized losses connected to treasury bond investments. What about unrealized losses stemming from corporate debt? Do you know who are the creditors most at risk from an Evergrande default? Let me save you some of the suspense. They don't have any money left, and all they do have are properties you can't sell. Evergrande liquidation ruling postponed in surprise to creditors. Who owns Evergrande debt? From Reuters. Fund giant BlackRock and investment banks HSBC and UBS were among the largest buyers of the debt of embattled Chinese real estate developer Evergrande Incorporated, Morningstar data shows. Who are the biggest investors in Evergrande itself? Top two institutional holders, Charles Schwab and Vanguard. So what should we look for over the next 3 days of the week? Well, we already know that Evergrande kicked the can over to next month, so they dodged that bullet. And now between Wednesday and Friday, could we hear something about the XRP settlement hearing with the SEC from last week? We already know the big bank boys are going to get grilled, but Wednesday, after the close, we're going to get GameStop earnings, and that comes after ADP employment and U.S. trade deficit. Now, Thursday, we see initial jobless claims and consumer credit, and then on Friday, the big number, U.S. employment report, employment rate, and consumer sentiment. GameStop reports quarter three. Everything you need to know ahead of earnings. Okay, I'll bite. Last quarter, GameStop reported revenues of $1.16 billion, up 2.4% year on year, beating analyst revenue expectations by 2%. It was a good quarter for the company with a beat of analysts' EPS and revenue estimates. This quarter, analysts are expecting GameStop's revenue to decline 0.4% year on year to $1.18 billion. Improvement on the 8.5% year over year decrease in revenue the company had recorded in the same quarter last year. Adjusted loss is expected to come in at 8 cents per share. Write that down. Now, GME closed at $14.91, down 2.07 or 12.19%. Totally normal trading, right? In the after-hours session ahead of its earnings day, it was up 28 cents or 1.88%. Now, GME is up 12.6% over the past 5 sessions, and that's one crazy gap up in chart formation. But what I'm most curious about is, did the hedgies overdo it today with this 12% push down? What if there's a surprise in the call after the close tomorrow? I will be watching closely as Amy loves to track GME. By now, most of my subscribers are immune to hit pieces on AMC from the financial press, but I predicted they would be intensifying, and I was right. These people should really give it up because I'm never selling until the hedgies cover in earnest. And there's no amount of hit pieces that are going to convince me to sell at these prices, but it's clear they're going to keep trying. From Investor Place, AMC stock is down 90%. But this analyst still says it's not a buy. From Tip Ranks, AMC Entertainment sell rating justified by capital concerns and weak box office outlook. And from Investor Place, Hollywood Shuffle, 2 entertainment stocks to drop and 1 to grab. Guess which one we are. And then from Fansided, 4 movies that will probably flop in 2024. Do you believe they have the gall to predict that Godzilla vs. Kong, the new empire, is going to flop? We're going to prove you wrong on that one. AMC closed at 7.02, down 47 cents or 6.26%, coming off an amazing third quarter, the best in its history, as a matter of fact, with its new distribution business in full swing, with both of its concert films in theaters and setting records, its retail popcorn line moving into new stores, but none of that matters. Whatever Wall Street decides this stock trades at is where it trades at. And to hell with the securities rules, laws, price discovery, all of it is out the window. And we have an investor relations department that's quieter than a church mouse. I'm hoping for some action Wednesday, but even my toughest critics will have to admit we ain't winning this trade without a black or white swan event. Now, I don't know if you guys agree, but all this talk recently about margin calls, margin spirals, and liquidations has me excited. For example, the altcoin market in the last 24 hours has experienced significant turbulence. Headline from Benzinga, over 335 million liquidated. Bitcoin, Ether, big time, Ordi tokens, sweep away traders' dreams. What happened? Over 335 million in liquidations across various altcoin futures involving Big Times Crypto and Ordi's protocol tokens took place. Liquidation in this context occurs when an exchange is compelled to close a trader's leveraged position due to a complete or partial loss of the trader's initial margin. This typically happens when a trader cannot meet margin requirements to maintain a leveraged position, lacking sufficient funds to keep the trade open. Now check this out, guys. Did you notice this article is written in a way to make you think this was small retail traders being liquidated? Ask yourself this question. How many people do you know that short cryptocurrencies or do cryptocurrency futures? Let me answer for you. You don't. I would bet dollars for donuts that these were institutional traders that got liquidated because they were short and the crypto market moved against them. Just my opinion. And an anonymous headline from Cryptopolitan. 20 countries queue up to join BRICS. Here's the list of the new world order. In a monumental shift on the global stage, a remarkable development has unfolded as 20 countries eagerly queue up to join the influential BRICS alliance. The BRICS grouping, originally comprising Brazil, Russia, India, China, and South Africa, has grown to be a powerful coalition shaping the geopolitical landscape. The decision of 20 nations to align themselves with BRICS reflects a paradigm shift in international relations as countries seek to forge strategic alliances that transcend traditional geopolitical boundaries. The implications of this expansion are profound as the new alliance evolves into a broader coalition that not only consolidates economic prowess, but also facilitates a collective approach to addressing pressing global challenges. In a recent interview, South African Ambassador Anil Suklal confirmed that 20 new nations have duly submitted applications to join the economic bloc. This happened 6 months after the BRICS Union invited 6 additional nations: Saudi Arabia, the UAE, Argentina, Iran, Egypt, and Ethiopia. However, Argentina might be the only nation to reject the BRICS invitation and remain outside the economic bloc. According to Suklal's remarks, only a limited number of developing nations express interest in becoming members of the economic bloc. In an effort to strengthen their domestic currencies, developing countries are abandoning the U.S. dollar for international trade. De-dollarization attempts are gaining traction as developing countries seek to break links with the U.S. dollar. Additionally, the alliance is the sole hope for establishing a new world order and uprooting the conventional financial structure dominated by the West and the United States. As a result, the U.S. dollar is at a crossroads and may lose value in the next years. The new economic bloc is building the framework for a future war between local currencies and the U.S. dollar. The BRICS countries have retained their role as key commercial partners, and new trade agreements are being signed this year. The new trade accords prioritize local currencies above the U.S. dollar. When trade between two BRICS countries increases, the dollar is the first to suffer. China and Saudi Arabia recently struck a trade pact that prioritizes their respective currencies, the Saudi Riyal and the Chinese yuan over the U.S. dollar. The 3-year deal allows trades to be settled in local currencies up to 50 billion yuan or 26 billion riyals or 7 billion. As a result, up to $7 billion in cross-border transactions will be settled in local currencies by China and Saudi Arabia. The U.S. dollar will play no role in new currency exchange settlements until it exceeds $7 billion. Well, guys, I don't believe XRP is going to be the one world currency, but I do know why everyone believes it's the standard for cross-border remittances. Keep an eye out on this. Now, you guys may laugh at this, but I think it's the most important slide in the presentation. From Collider, Napoleon Global Box Office conquers new heights. Napoleon earned $35 million in its second weekend, bringing its worldwide total to $136 million in just 2 weeks. Here's the important part. Let's see if you pick this up. The film is essentially a streaming release from Apple, with its theatrical run serving as advertising for its eventual release on Apple TV+. Guys, this is the future, okay? I'm excited about distribution and concerts, but not everybody draws a crowd like Taylor Swift. What we have to understand about this slide is we need all the big streamers to take their original content and debut it in the theaters first. So keep an eye on Napoleon. The more successful it is, the better shot for AMC. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.